Let's get ready for Monday Mortgage Minute with your hosts, Tom McNamara and Bruce Woodburn.
All right. Happy
Hello,
Monday.
Bruce. It is Monday.
We're almost finished April.
April's been an interesting month, man. It's been hot and cold.
It has been hot and cold. Speaking of hot and cold, interest rates are the big topic. It's been all over the news. Interest rates drove north at 7% range in the last couple of weeks. It's been rocky.
Yeah.
However, I think today is a little bit better. So the good news is for everybody, it's not getting worse today. How about that? Right?
That's not the best good news, but I guess it's better than the bad news,
Well,
right?
you know what? Our listeners can count on us for the real information because this is not a sales pitch. You got to say it the way it is.
Yep.
It's interesting because we got a client that we're working on that was concerned that his payments were going to be too high for him based on the amount of house that he wanted to buy.
Right.
But it was fascinating that are you truly aware of where your payments are going to be based on what it is you desire? Because, it's just like somebody coming to you, Tom, and saying, hey, I'd like to buy a house in Heathrow. I'm looking for a 4.3 with a pool, and I'd like to get it under 300. And you're going to be like, well, I don't think you're going to do that. Right.
My time machine is broken this week.
Yeah. Right. So, but it's the same in our industry. So you're looking, you want to buy a $550,000 house and you want to put $100,000 down. You're still at a $400,000 loan. Where do you expect your payments are going to be? And once you add in insurance and taxes and HOA fees and everything else, you got to be prepared for what your payment is. So it is important to have that dialogue with the lender that you choose so that you're well aware of
100% absolutely is.
Where your payments are going to be.
Yeah, because the payment. I mean, I can calculate a mortgage payment, the PI portion, right? I can do that in my sleep. It's easy. I've got a calculator. It's not a complex thing to do, right? Where it gets tricky is, looking at things like taxes, right? So in this case, this person wanted to sell a house and buy a house, so they were able to do portability. And it took me about an hour on the phone with the county to figure out how much portability they had. Now I know how to do it. So next time it'll take me 10 minutes, but it's right. I wanted to figure out how much portability this person has. So I can figure out what their new tax burden would be. Right. And unfortunately for them, they were going from a tax burden on probably a $260,000 house up to a tax burden on a $550,000 house. Well, even with the portability, taxes went up quite a bit, right?
Quite a bit. Sure they do. But you have to be aware if you are leaving a Florida primary residence to go into another primary residence, that your portability is available and it is a major tax savings.
Oh, it made a big difference. They have almost $100,000 worth of portability.
Sure. And here's the thing, you're transferring your exemption over to the new property. So it makes a huge difference. Now, the dilemma is, and that what people need to be aware of is, regardless of whether you're eligible for portability, you cannot get the benefit when a lender uses that number at closing. They've got to use whatever the current taxes are for reasons. And this goes to same with veterans that are disabled, that are exempt from taxes. You have got to own the property before you can apply for the exemption, before the lender can use the exemption.
Yeah, exactly.
So, and in our case, how many times do I remind people to file for homestead exemption and they go, oh my God, I completely forgot to file. And my taxes just went up $300.
Yeah.
Right.
Hey, I don't know if I ever told you this, but I work with a lot of distressed homeowners, and I had one time. This was probably 3 years ago, down in Kissimmee, and they called me to sell their house because they couldn't afford the taxes anymore. And when I looked, they had bought it in like 2009, never homesteaded. Yeah. So the house went from 100,000 to 350, and they couldn't afford the taxes anymore. I'm like, and they're like, well, can't we go back? I'm like, no, you can't.
You can't go back.
Yeah, you got to file that homestead right away, man, for sure. But yeah, and so we had a tax surprise for him, right? We had a rate, I'll say, misunderstanding, right? Doesn't understand how much rates can actually impact, right? Because not everybody, we do this every day, right? Not everybody keeps up with this as tight.
Absolutely.
And then on top of that, he needed to get a FHA loan, or at least we think he did.
Well, the scores lend themselves to being more favorable to an FHA loan. Now, he could potentially go either direction at a 650 credit score, but it's definitely lends itself more so to FHA than conventional. But in that case, I would run both scenarios to see what's going to be better.
Well,
and
yeah,
since he's putting 20% down, he can avoid the mortgage insurance.
And he is putting 20% down. So, yeah, because that mortgage insurance. Now, let's talk about that for a minute, because mortgage insurance, it's not your property insurance, right? It's not your casualty or right. It's actually basically like an extra payment to the bank, so that you're mitigating their risk, right?
It allows a buyer to avoid putting down 20%, which would be difficult for a lot of people to do.
Sure.
Right. So it allows them home ownership without putting down 20%. But what the mortgage insurance does, and on a conventional loan, it's called PMI, private mortgage insurance. On an FHA loan, it's called MIP, mortgage insurance premium. And there's two forms. There's upfront, that's financed into the loan, and then there's monthly as well. And then on VA, it's called a funding fee, and on USDA, it's called a guarantee fee. All means mortgage insurance. No matter
Why can't we just call it one thing? But okay, fair enough.
So it's all different, but it's all different, but it's all the same. And all it does is insures the lender in case of default. And the thing is it doesn't insure the lender for much. I mean, because depending on your score and depending on the loan to value, depends on the percentage of coverage they get.
Sure.
So a lender might only get 25% coverage. So if you went into default and the lender lost 400,000, they're only getting covered by 20 or 25% of that. The rest is still a loss for them.
Sure,
right?
sure, right. But I mean, it can be expensive. I mean, I don't know, I don't know how the numbers work, right? I know that it's a complex solution, right? You guys can figure it out. But I mean, I've seen it being as much as a couple $100, which is, I mean, that's like a car payment almost.
Oh, sure.
Or an old car payment.
So here's the thing though. I will tell you that in my opinion, PMI is the best thing that ever happened to our industry. And if it wasn't for PMI, most people would be renters. Most of us would not be homeowners, because it's very difficult to come up with 20% to put down on a house. First time home buyer would never be able to buy a home.
Yeah.
They'd never. So what you do is you get into the home, you pay the PMI, and then as the home appreciates, you're able to refinance it. Now, what if you can't refinance it to where you still have 20%? Well, you refinance it to a conventional loan and the PMI goes down. Now, on an FHA loan, the PMI does not go away, period. Does not go away. So
you have to refi out of a FHA to get it to go away.
That is correct. You have to refinance yourself out of the FHA loan into a conventional loan. And that's a motivation for the individual to improve credit scores if that was their issue, or gain more equity in the property. So you always want to be trying to improve your credit scores. Keep in mind that interest rates that lenders or banks charge you, they don't just willy-nilly make up a rate because of what your credit score is. Pricing exists. It's called loan level pricing adjustments. Fannie Mae has theirs, Freddie Mac has theirs, HUD has theirs, VA has theirs, but they all have different algorithms. But the higher the risk, the more the mortgage insurance, or the higher the interest rate. So when we have less than good credit scores, you are dictating what that bank is going to charge you for an interest rate and mortgage insurance.
Sure. Yeah, that makes a lot of sense. You mentioned first-time home buyers and FHA and all that. I did want to bring up that we are doing that. We got a date for our Hometown Heroes workshop that we're going to do, right?
Yeah, so we're going to do a workshop on Hometown Heroes and other down payment assistance programs for anybody that is a first-time home buyer or maybe seeking to get into the housing market, and cash to close may be an issue for you. So you want to understand what the credit score requirements are, what the income requirements are. How much money can I get? Do I have to pay the money back? Which programs require you to pay it back? Which ones don't? Are there better interest rates with down payment assistance programs, or are there not better interest rates? And different programs offer different features and benefits. So we're going to cover all those for all the local counties so that you've got a great idea as to what might be suitable for you. That's going to be on May the 23rd from 6:30 to 7:30. We may go a little over. You need to register at webringyouhome.com. So listen, realtors, builders, buyers, anyone that has kids in the family that are adult kids renting, any renter, you should be coming to this. Tom and I are here. This is an informational class. So whether you are, anything in anyone in our industry or out of our industry, if you seek to understand, we will be here to guide you in the right direction for that. So you'll need to register, and there's limited seats. What do we got? About 25 seats in that room?
About 30. We can do about 30. We can shoehorn in about 30 people.
Yeah. So, but do register at webringyouhome.com. That will be May the 23rd at 6:30 p.m. in Maitland, Florida. So register right away for that class, and we'll get you in.
Yeah, we'll put that link in the description when I do the description today.
Yeah.
So, Bruce, it has been great. Do you have anything else you want to say?
Well, I just want to tell you that don't think that PMI is a bad thing for you. PMI can be embraced, and it will allow you to avoid renting. So if you are concerned about PMI and then you're paying rent, you are not thinking straight. You're paying 100% interest rate for nothing to gain for it. And you don't want to do that. You don't want to do that. So
no.
Yeah.
So, yep. All right. Well, hey, very good. I look forward to obviously I'll see you next week, but we'll have to be preparing for this workshop, and look forward to seeing how many people
get enrolled in it right away. Yep. Thanks.